when you're an individual investor, the one thing you've got is time and really the ability to not have to answer to anyone. And I think that for a lot of individuals, this is a place where they can really kind of exert that leverage.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. Welcome back to the Phil Bach Podcast. It is no secret that the United States faces an aging infrastructure, and it's a fascinating area of the investment landscape that requires an understanding of broader areas such as technology and politics. My guest today is one of the leading experts on infrastructure investing. John Bartlett joined Reaves Asset Management back in 1995 and was named president of the firm last year. He remains a portfolio manager on two of the Reaves utilities funds. And we're going to hear about the case for investing in utilities and infrastructure at a time when everyone else is focused on high volatility tech names. So it's a contrarian play. John, thank you for joining the show.
Well, it's my pleasure, Phil.
So, John, you spent your entire career at Reaves, which is very unusual. Tell us about how you got started there and how your position at the company has evolved over time.
Well, I have been at Reaves for a very long time, basically my entire adult life. I first met Bill Reaves when I was in college, and he had hired me to be a summer intern. I finished college. He did not have a job for me at the time, but after a couple of years went by, my phone rang, and of course, when he offered me a position, I jumped at the chance. And since then, I've really kind of done a lot of different jobs at Reaves, but most of my career has been spent being a utilities analyst. And then, over time, as my career has gone on, I've moved on to being a portfolio manager. And lo and behold, from summer intern, now I'm president. So it's really been a dream come true for me. And it's been a great way to spend a career. Never thought of ever leaving, and have really enjoyed it a great deal. So.
That's great. That's increasingly rare to see somebody stay their whole career at one firm and to rise up like that and ultimately to become the president of the company. It's a really cool story. Tell us a little bit about the corporate culture at Reaves and, the key value proposition and edge that you guys have.
Sure. Well, we are industry specialists, and that's really our edge. We spend a lot of time looking in places where really a lot of people don't spend as much time looking. We think that they should. If you kind of look at what we do broadly, our entire practice, we do focus on infrastructure. Really, the firm started with Bill Reaves hanging out his own shingle in 1961. He was the lead utility analyst at Kidder Peabody. That was at a time when the industry was raising a great deal of money to expand America's electric infrastructure, and he was really getting drawn more into investment banking than into securities research. So he under the protection of fixed price commissions, decided to give it a shot on his own. And then in 1978, the firm transitioned into managing money. And so we've been managing money professionally since that time.
So tell me about infrastructure from a high level. Why does it matter? What is the state of infrastructure in America? And, why is it an important area to focus on?
Well, we really put infrastructure into three buckets, and we have expertise in all of them. The first are the public utilities. And the story there is as much about aging infrastructure as it is trying to accommodate what customers want today. And what customers want today is grid reliability, right? Our little electronic devices have become a lot more important than they ever were. People want renewable energy, and they want stable rates, and probably all in reverse order. And so that's what utilities are really endeavoring to do. Get the generation stack changed, get the grid accommodated to really managing it in a more efficient way and in a more reliable way. And then lastly, trying to really use cost cutting as a way to keep rates stable. That's really the story at utilities. Now, we also invest in communications infrastructure too. And our favorite play there are the cable companies. And the tie that binds, of course, is that a lot of these companies provide an essential service, non-discretionary, and it's a service that's obviously become less discretionary in the sort of modern COVID paradigm. And, we see very, very deep moats there. We don't think that they're going to get unseated by 5G. We're also happy to invest in companies that are going to be the leaders in 5G. So we do own some of the wireless stocks. Our largest position there is T-Mobile. And then finally, we're also long students of the energy infrastructure business. We've really kind of wound that down in terms of our investing over the last few years. And, we are always on the lookout for value, but growth is important to us too. So we're a little wary that the growth proposition in energy is going to be absent for some time to come. So that would be really my quick overview of infrastructure investing as we pursue it. Now, there are other things that people do on the investment front in terms of infrastructure. They're all valid infrastructure, but it's a little separate and apart from what we do. There's things where there are public-private partnerships. There are airports and highways and bridges and things like that, where people invest in infrastructure on a private basis. But what we're really geared up and set up to do is to invest in liquid infrastructure. All of the stocks that we own are very big and liquid. They all generally have the ability to have a very stable stream of cash flow and generally have a lower volatility, a lower growth rate, and a higher dividend yield than the rest of the stock market.
When you travel around internationally, you can see that other countries are way, way ahead of the U.S. when it comes to their rail systems. And in New York, you look at the subway stations, and it just doesn't compete against what you see in other countries. And we have an incredible highway system, but it was built a long time ago. And I know famously a year or two ago in New York, the Tappan Zee Bridge needed some major repairs. And in a lot of senses, I think the infrastructure in the U.S. is really showing its age, and there are going to have to be some revamps and some real projects assigned. How do you capture that in your portfolios? And I mean, do you agree with that assessment in the first place? And then if so, how do you capture that on a going forward basis in your portfolios?
Well, I've been a sad rider of the New York subway many times and been over the Tappan Zee Bridge and sat in traffic on the Cross Bronx to understand all of those things. Part of that is an accident of history in that New York City was built well before the car. And so it has a hard time accommodating it. And of course, the subway system was one of the earliest subway systems built and was built exclusively with private money. So people wonder why the Washington, D.C. Metro is so much nicer than the New York subway. Well, the easy answer was that the D.C. Metro was built with unlimited money. That's a big part of why the United States, certainly public transportation infrastructure, looks so different from Europe. And our reliance on the car has not really served us well past the 1960s. So those are all issues. As far as the health of the communications infrastructure goes, all of these things that are handled by private companies, the situation is better than it was, say, 10 years ago, and it's continuing to improve. And if you were to go look at all of the electric utilities in the system right now, you pretty much could look at the companies that had a financial problem building a nuclear plant in the 1980s, and it would still reflect poorly on the state of their infrastructure. And the reason was they just weren't spending enough money on it back then. That situation has really changed. The CapEx trajectory for the investor-owned utilities is much higher than it was when I started my career. And your average utility is growing what we call its rate base, that is, its invested capital in its system, by about 5 to 6%. And that's typically above its depreciation rate. So its invested capital is going up a bit every year. And the balancing act there is spend the money to improve the infrastructure. But remember, utilities are paid by the capital they have invested in their system. So you can't just spend. You've got to get rate recovery in order to do that. So there's a careful balance there. And what I like to say is that utilities really have to earn the right to grow their earnings, because yes, you pay your bill on volumes and you can review that in your monthly statement. But as a practical matter, utilities don't grow their earnings on the basis of sales over time. In fact, there are plenty of utilities that haven't grown their sales to customers they haven't grown their sales over the course of the last 10 years. So again, utilities have to be crafty. They have to learn how to do a lot with a little. And when you look at the core competency of utilities, I would kind of highlight as the biggest part of it.
But when a utility spends money on CapEx, is that just patching up, little repair jobs along the way? I mean, that's not a whole revamp and modernization of the system. That's something completely different, right?
Well, it really depends on what aspect you're talking about. A lot of utilities, it is a revamp of the system in a lot of ways. But here again, it's really a question of finding out what you can do to kind of improve outcomes for customers the most effectively. And so, transporting electricity is not a very high-tech thing. And we've really kind of got a handle on it. There is a replacement cycle, and that replacement cycle has to go on really come hell or high water. And if you look at, say, the average age of a lot of systems, I should say, the average age of the system could very well be older than the depreciable life of the assets of the whole system. And that's actually kind of okay. The question is, what can you do to improve the customer experience? What can you do to keep the lights from going out? And when they do go out, what can you do to get people back as quickly as possible? And one of the great leaders in that has been Florida Power and Light. The parent for that company is NextEra Energy. Florida Power and Light is really kind of America's utility, to take the Dallas Cowboys analogy. They've done a great job controlling costs. They've done a great job, what we call storm hardening their system, putting up steel and concrete poles, raising up transformers so they don't get flooded out during hurricanes. And just kind of blocking and tackling like that, just making sure that they're really kind of using the latest and greatest technology to, if there's a circuit that's overloaded, then, to protect the rest of the system from it. Just a lot of things like that. And then that spending has real results. The Florida Power and Light system, if it's out for a day, the estimated economic cost of that is about $1 billion a day. And for them, they've spent $3 billion over the last 5 years or so. And so, a 3-day outage, to the extent that that's prevented, that's just paid for itself for ratepayers. So the electric distribution system is a little bit unlike the New York City subway insofar as it needs a total revamp. But that said, there are things that utilities can do to spend money and grow rate base and have a value proposition for the customer. So that's really the key thing here. Electric utilities don't need to revamp the whole system. They don't need to put all their wires underground in order to have a sustainable growth trajectory. Really, as far as I'm concerned, a utility that's growing its rate base at much more than 8% a year is going to have some growing pains. And so what we're really looking for are companies that can grow their rate base at 5 to 6%. They can grow their earnings maybe in line with that. Maybe they grow a little faster and the earnings go up a little bit more. They pay a 3.5% dividend. And if we're doing things reasonably well and buying them correctly, we might have a chance at a 10%, maybe 11% total return. And, that may sound fairly pedestrian, but that's what we're shooting for. And the thing that we're trying to achieve here is a low volatility return with a low beta. And not to get overly wonky here, but if you plugged really a 10% total return with a beta of 0.3 into CAPM, you've got serious alpha creation. And so that's what we're looking for. And I'm, happy to talk about, the other things that we do and the risk parameters there, but it's the basic electric utility model that is kind of the bedrock of what we do. And, we'll take on more risk here, but this is really what we're seeking to do here with utilities. Should be considered sort of the lowest risk part of anyone's portfolio. And candidly, they still remain institutionally underowned, and they're still a pretty small part of the S&P 500. So it's our opinion that people continue to look over these stocks. Now, things are a little different in the natural gas utilities, the gas distribution companies from whom you heat your homes and fire your stoves. There, in a lot of cases, the system does need to be overhauled. And these companies are ripping up pipe at a pretty quick pace. And you've probably seen that in your own community. And the reason for that is simple age, right? And those are systems that really are too old and really do need to be crumpled up into a little paper ball and thrown away. And it's the job of the utility to highlight the places where they have to do it most urgently. You can't do that all at once because there's just only so much crews available to do that. It's long, protracted work, and it happens over many, many decades. And the way we sort of look at things now, the average utility probably has 20 to 30 years of work to do. And they can't grow their rate base more than 8%. So what that means is they have a backlog of installed work that can really go on for an awfully long time. And it's that backlog of work that provides the sort of grounding to the long-term earnings growth trajectory of 5 to 7%. And when you can grow your earnings at 5 to 7%, hopefully you can grow your dividend at about the same rate. So I hope, Phil, that that's given you kind of a sense of what we're shooting for here.
Yeah, I mean, that's a really broad, that's a really great overview. And the interesting thing to me, I mean, when you think about an equity portfolio manager, you think about somebody who's, got their Bloomberg terminal open and, maybe running some data through Excel, but, you're working with these utilities and these projects. Do you ever get the opportunity to go out and inspect them on site and to really, see, feel, and touch the different projects that you work on or that you invest in?
Well, I'll be candid. Seeing big iron really, I never really grew out of that, even since I was a little kid. I love big projects. And I do love watching big plants getting built and big construction projects generally. And I think maybe every grown man does still retain some level of that. I can't speak for everybody, though. So anyway, I think rather than look at big projects, as fun as that is, what's more valuable to us is to be involved in the regulatory process. And that's really the most, I would say, the single thing that's distinctive about what I do as an equity analyst and a portfolio manager relative to sort of other sectors and industries. We say that really for every company that we follow, we really follow two companies. We follow the company itself, the operating company. We talk to management, we listen to conference calls and all that stuff. But we also have to follow their regulator. And we read a lot of regulatory filings. We really try to find companies where the regulatory environment is improving and try and stay away from those companies where there's political decay. And what we really look for more than anything else are companies that can provide political victories to their regulators. And I know that really doesn't seem like a stretch, but it's amazing what happens in practice and how often companies do happen to stray from that. It's really your regulator is your customer as much as the person who picks up the phone and calls you because their power is out. It's really a kind of critical part of what we do. So that's for us sort of more important than visiting construction sites, really just kind of understanding which way things are going. And to the extent that companies might or might not have a regulatory hiccup, that's a big deal to us.
So are you talking about how they manage the regulators in terms of, not getting into trouble, not getting fined and adhering to regulations? Or are you talking about different stimuluses, different benefits if they're doing renewables and different, government programs that they can participate in? Is it the carrot or the stick that's driving them?
Well, a good company will try and stay away from the stick and manage the carrot. Curiously, we don't want our utilities to be that successful. And the reason I say that is because if you are earning too much money on your assets, it's unsustainable. And if you dupe your regulator, it's only going to lead to resentment. So what we really are looking for here is not necessarily the amount of, allowed return and all that stuff. That's all driven by the regulatory process. The amount of money that a company is allowed to earn on their investment is very important to us, but it's not just that. It's, we want a fair return, but we want a stable return. Remember what I said before. We're shooting for low double digits returns here with a very low beta. And so getting that stability is as important as making the extra buck, and probably more so. So that's all something that we look at very, very closely. And the rate setting program in most places is done on this long adjudicated court case called a rate case, where the Public Utility Commission sits as judge and jury, and there's two sides, the company on one, and the staff of the commission, various intervening parties, sit on the other. And they try to put together a record that supports what either side wants, and the commission weighs in on that. A good company will settle that before the commission has to make a public decision. And a great company will do whatever it can to not to get into that proceeding to begin with.
Is there an arbitrage to be had? Is there a way to manage the portfolios where you're taking in, if the rates are being determined by this bureaucratic entity or some negotiation with them, is there a way to get out in front of that or be able to predict that or even try to influence that and have that impact your trades and get out in front of that as a strategic way to try to manage a portfolio?
Well, that's what we try to do. And that's why being an industry specialist is so important. Because by the time the newspaper picks it up or Bloomberg News picks it up, really the financial community, my peers and colleagues at other investment management firms who do something similar, really, we've already expressed our investment view in the stock market. And so it's really incumbent, if you're going to be a professional utility investor, to do exactly what you've described.
Well, what about the upcoming election? So when you look at renewables, I think the different political parties might have very different plans or incentives for, let's say, a wind farm or a solar farm or different renewable energies. How impactful is the election outcome or even local elections to these different projects?
Well, local elections are curiously much more important than the presidential election and congressional elections in the Senate, for that matter. The federal government regulates interstate commerce. And so as a consequence of that, if you have transmission lines or a gas transmission line that crosses state borders, that's regulated by the Federal Energy Regulatory Commission. But retail power and retail natural gas that's used by real residential customers is generally regulated by the state. And it's the State Public Utility Commission that really is the driving regulatory force in the lives of most utilities. So with that in mind, the states have all kind of come up with their own renewable mandates, and it'll be interesting to see what happens in a Biden administration. I've got a couple of views on that, but generally, in broad terms, I'm always more important. It's always more interesting to me how a particular governor is going to do in a state than who's going to become the next president of the United States. This time around, there are a couple of interesting things. I think the one that's really most impactful for utilities at this point is a change back up in the corporate tax rate, okay? And I say that because utilities recover all of their expenses in customer rates, okay? So if the tax rate goes up, there should be some recovery in utility rates, and the impact on net income will probably be not very much, and that is obviously going to be better than your standard tax-paying corporation in the S&P 500. Now, that said, what's important to get that to happen is that rates will have to go up, and no utility ever really wants that. But if you've got a situation where corporate taxes are going up, utilities just sort of, by the way they're conceived, will have an advantage in the stock market. I can't quantify that, but it should be something. When they lowered the corporate tax rate, utilities got hurt. And so I think just keep things simple. Some of that might get reversed. So anyway, as far as renewable policy goes, there's still a lot in the air, and it's not clear to me what both sides of the equation are going to do. I would say a renewable portfolio standard for the United States of America, which is something that's been kind of bandied about, would probably help a couple of utilities, but not all of them. And I would say whatever number we came up with would probably be close to being achieved in each individual state anyway. Something really important to understand about renewable energy: it's economic, and it actually can lower customer bills in some cases where it's getting deployed. Remember, the cost of these things to build them is coming down consistently. That's wind, that's solar, that's batteries, and they use no fuel. So to the extent that the capital cost is coming down, you can install these things, you can lower customer bills, and then you can change trade and operating expense for a capital expense. And the largest capital expense for any new construction project in a utility is something called earnings, okay? Utilities are allowed a return on all of their investments. So to the extent that we increase earnings and lower operating costs, and, if no net change to customer rates, that's just simply fantastic for a utility. And renewables have kind of enabled that to happen in a lot of cases. That said, it's a little bit, because they're all intermittent, except for, of course, batteries, which can help, but they're not a panacea. Yeah, as we get closer and closer to 100% renewables, they get progressively more expensive. And the reason is that you have to have resiliency in the system, and the intermittent nature of renewables sort of gets in the way of that. So we'll see. And the industry is doing a pretty good job of getting rid of its carbon emissions. And it really doesn't need, in my opinion, a whole lot of support from the federal government, because that whole effort is kind of ongoing anyway.
Two of the bigger themes that we're seeing right now due to COVID, we're seeing an exodus from big cities, and a lot of people are moving out to more rural or suburban areas. And commercial real estate is in a pretty perilous situation. We'll see what happens if people come back to the office or not. For either of those trends, is there a way to play them using infrastructure utilities?
Well, remember what I said earlier about sales growth, right? And then obviously there's going to be demographic trends. Maybe more people are moving to Florida because now they can, whereas, maybe they wanted to, but they had to stay close to the office. Those trends, migration may be going up, and there may be utility winners and losers, but the things I also talked about, the regulatory dynamic and the rate of investment in the company, those I think are going to trump that for the time being. There'll, of course, be exceptions. I think the key thing that I would leave you with, though, is when you look at what the utilities themselves are going through relative to what's kind of going on in not just commercial real estate, not just retail and things like that, is the utilities are probably going to wind up being the only sector in the S&P 500 that have a positive earnings comparison this quarter. And the reason they have a positive earnings comparison this quarter is that, again, they are getting hurt with industrial sales. They're getting hurt somewhat with commercial sales, but residential sales are going up because, frankly, people are spending more time at home. They want to run their air conditioners all day long, whereas they might have turned them down during the workday. And so, in essence, yes, you're absolutely right. The work at home environment is having a positive impact on customer mix, on sales mix, I should say. And utilities are really very well positioned for the work from home environment. And even though they're losing some sales from their commercial industrial customers, those sales are lower margin. So there's a mix shift going on in their revenue stream, which is helpful. And I like to make the case, and this recession is really proving to be no different from the other ones, is that utilities, their earnings stream are not perfectly acyclical, but they're pretty darn close. What really is the first order impact to long-term earnings growth is how much money these companies are putting into their system. How much money they make in a summer is really most driven by weather, but analysts like me tend to normalize for that. We look through a hot summer, we look through a cool summer, and we're always sort of looking 1 or 2 years out as to what earnings could be. So here again, the business cycle doesn't figure too prominently in that. And if one of the slides that I used to love to hand out to folks was to take DTE Electric's, take their earnings year by year and plot it against auto sales. And it is just laughable that there was just no relationship between how auto production zigged versus how earnings very consistently rose year by year.
Yeah, that's maybe, I'm in Detroit, maybe, and I'm a customer of DTE, and perhaps that's because we lost all the factories here. There are very few still in Michigan.
Well, it's not actually. It's really because all those big factories, and they're still big factories and they're still big industries, really all have very low rates. Now, as you also appreciate being part of DTE service territory, they're sort of the donut, and the city of Detroit is the donut hole, not to be too pejorative. And so they have their own electric system downtown. So it's sort of outside of their service territory, but I think the same thing would be somewhat similar.
In terms of utility stocks, they're squarely on the value side of the fence. It comes to value growth or value momentum. And how sensitive are the stocks to that pendulum of growth to value? Whatever those forces are that are moving seems to be the factor of value or the factor of growth at different times. And we're coming off a long cycle of value underperformance. How sensitive are those utility stocks to that value factor, and how much have they been either a victim of the value factor being out of favor in recent years or the beneficiary of that boost when value is in favor?
I would share a couple of observations. The factor that really seems to be moving these stocks really over the last few years has been the low volatility factor. And if you looked at low volatility funds coming into the year, there were plenty of them that were 27, 28% utilities. And what we had in the first quarter was that as the market decelerated down in March, the old cliche kind of held true that correlations went to 1 and utilities were getting dumped just as fast as everything else as there was a cash crunch. So as a consequence of that, what we saw in the second quarter was that utilities were up, but they weren't up very much. And I know that the second quarter really was a quarter where if it was levered or if it was high risk or, if it was low quality, it tended to do better. But utilities did do a little worse than they should have. And they were up around, I guess, about 2.5% for the second quarter. And I would attribute that mostly to a lot of the low volatility investors resetting their historical metrics and rebalancing their portfolio. What we're seeing today as a practical matter, I fully expect utilities to return to low volatility investors just as soon as the numbers merit it. And we're already seeing some companies from utilities start to creep back into that low volatility space. So for instance, over the last couple of days, there's a gas company in Texas called Atmos Energy. And it is now, hopefully, if we can hang on for the rest of the week, it will re-enter that particular low volatility factor at the end of the month. And so it'll be interesting to see what the dynamic there might be. No promises on where it's going, of course, but I would expect over the next 6 to 12 months, the business model and the stability of the earnings here is going to really keep volatility certainly lower than it was in the first quarter relative to the rest of the market, and start to bring these companies back into where they ought to be in terms of the low volatility factor. As far as the long-term record of utilities goes, really the most important thing has traditionally been its relationship to interest rates. Now, for a variety of reasons, that's broken down considerably with treasuries. It's broken down. It's still pretty close with BBB bonds. From my perspective, there's always a constituency of folks who invest with us, me included, who really look at what we do as being a bond substitute, right? And the idea is rates are so low right now, the utility rate on its own is nominally competitive with corporates, but you've got the opportunity for a rising coupon. And yes, you probably have a bit more duration risk than you might have in a 5-year bond. But at the same time, if we get back into rising interest rates, if that ever happens, you'll have, in essence, the rising coupon to help make the headwind a little bit more palatable.
I just find it really wild that low volatility as an investment factor has gotten so big that it's a real driver of the price of a utility stock. I mean, that's just so wild to me. It's so disconnected from the real value of what that stock is, what that utility does. I mean, it's got nothing to do with anything. And honestly, it's a little bit scary to know that that is what is driving the price.
Well, that's why investors really have to count on a couple of things. Everybody has to understand what their competitive advantage is in the world, right? And I could speak chapter and verse, having spent 25 years in this, following this industry. But this is an industry where I think you can afford to be patient, and individual investors really should understand that to the extent that these stocks get whipped around by things that you can't really see, you can be very comfortable, I think, with the earnings trajectory here. When you're an individual investor, the one thing you've got is time and really the ability to not have to answer to anyone. And I think that for a lot of individuals, this is a place where they can really kind of exert that leverage, if that makes any sense to you.
Well, it's a really interesting space, and congratulations to you on your success and on the company's success. And, I like to close with this question, which is, tell me if you've had an obstacle either in your personal life or your career that you've either found a way to work around or persisted through.
Well, it's a good question to end on because I think we kind of started on this. I've had a wonderful career following utilities, and I'm very fortunate not to have had any great tragedy in my life. And in fact, my daughter actually recently asked me, and she's just turned 11 today, what's the worst thing that's ever happened to me? And unfortunately, that's easy right now because I recently lost my father. But, that's a rite of passage, and I don't think that really distinguishes me from anybody. What I would say is that when you are an investment professional, you are faced with adversity on a very regular basis to the point that it can be counted on, and almost to the point where you're never perfectly immunized from it. You get kind of accustomed to it, and you learn how to sort of dust yourself off over time. I will say that being associated with a small little company that really takes a great deal of pride in doing what it does has been wonderful. But one of the things that I have to laugh about now, I once rented a U-Haul truck from a fella who was running the business out of his own house, and over his desk he had a sign that said, "The two most overrated things in life are natural childbirth and owning your own business." And that's not entirely true, but it certainly has had its challenges and its ups and downs over the years.
So, John, where can people learn more about Reaves and read your research?
Sure. Well, we do publish and we do keep a blog. We don't sell research or anything like that. But if you're interested in learning more about infrastructure, we've got a fairly large piece that's probably going to be coming out in the next week or so, if it's not there in the next week or two. But anyway, our website is Reaves, REAVESAM.com. And if you're interested in our flagship fund, which is a closed-end mutual fund, the URL there is utilityincomefund.com, and that's the Reaves Utility Income Fund. We also have an actively managed ETF, the Reaves Utilities ETF, and the ticker symbol for that is UTES.
Well, congratulations on getting through all that and everything that you've done. Thank you for coming on the show. Thank you to the listeners for your time and attention. Please subscribe. Take 2 minutes and throw up a rating if you have a second. That'll be really helpful for us. And we'll be back with a new show next week.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.